good morning, everybody. Gonna give people a few minutes to hop in here, and then we'll get started. All right, good morning, everybody. So I'll just start out pretty much like always. This is not like some high quality YouTube production. I have no aspirations of being a YouTuber. So today I want to briefly go over POCs, volume area, volume profile, and then my main focus for today is just how I trade. So as far as POCs, volume area, volume profile, I have, I think, several videos on all of those. So this will not be in depth on that, but if you want to get more into in depth on those subjects, you can check out videos on my YouTube channel that already cover those. This is going to be more about the actual trading aspects, but basically, I'm just going to grab a chart and run through it like I would on any given day, where I look at like the night before. I'll start on the 1 month time frame. I'll go to the week, the day, 4 hour, 2 hour, 1 hour, 30 minute. On the 30 minute is where I draw my POCs and virgin POCs. And then during the trading day, I'll just look for technical analysis, and I use my POCs and virgin POCs as targets for price action. So I guess we can start on Apple here. I like to start with a naked chart, and I'll go to the 1 month. And from here, I just like to see if I notice anything, of specific interest. Really not much to see here other than an uptrend. So you can see here, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. That's very basic concepts. Everybody should understand. We either have one of three things happening on a chart. We have an uptrend, downtrend, or consolidation. Anyway, so on the 1 month, nothing of significance here other than an uptrend. Nothing I'm going to be charting on. Weekly chart on Apple. Same thing, just an uptrend here. Oh shoot, sorry. It's supposed to be the 1 day. This is close to being a head and shoulders, but this is too big. All right, so once I get to the 30-minute, I turn on my volume profile. And from here, I like to plot out my POCs and virgin POCs, and I label them. I only plot the ones that are, uh, of interest as far as trading. So we have POC here. It's actually a virgin POC. This is from January 3rd. So normally what I'll do, I'm not going to do this for all of them, but when I'm charting, I'll put January 3rd, virgin POC. That way at a glance, I can see what date this happened on and if it's virgin or if it's a POC. And again, I'm just going to grab the significant ones. And if you're wondering what's the difference between significant and insignificant, it probably comes down to some personal preference, but also uh, you just want to think, like this POC here, I don't need this. It's so close to the one before that this POC alone below it will cover this range anyway. And then all of these POCs here, if anything, you could draw a rectangle here, to cover all of these. Like this is an area you're probably not really looking to trade because there's so much choppiness happening through here. So I will grab this one here on the bottom, but I'm really more interested in this one as this is going to be a virgin POC. So, oh, actually, I'm sorry, it's not. It was touched here. I can't tell. Let me turn off. Okay, no, it wasn't touched. So I'm looking for a touch on the following day, not during extended hours. It can get touched on extended hours on a different day, but not the day or night after it was formed. So this is a virgin POC, and you can see by turning off extended hours, these POCs actually would move. So you do want to have extended hours on when you're plotting them. But so this one's going to be very significant because this is a virgin POC. And then we also have a virgin POC down here. So it's quite likely that price will get pulled down to one, if not both of these. So from this point, once I've got my POCs drawn out on a chart, uh, and I'll look for some technical analysis. Um, like this, I could be looking to play a break of Tuesday. So I'm sure most people would get the general idea from this. Um, when I'm charting, I plot out my POCs, virgin POCs, and from here, um, like on each time frame, I'll look to see if there's chart patterns that I could possibly play the break of, the following trading day or following trading weeks. It doesn't really matter, months, I don't care. The further out, um, or the higher the time frame that you find a pattern on, the longer it's going to take to play out, and the bigger move you will see when it breaks out of that pattern. So I'll try to chart out anything I see, on the higher time frames. But once I'm actually trading during the day, I'm pretty much always on the 3 minute time frame. And I'll just show this here really quick. I'm going to remove these lines, but generally, um, when you're looking um, for your entries, you're really looking for like the where there was resistance before or where there was support before. Um, so if I'm entering to the upside here, I want it to at least get over the wick of this candle here before I take this trade to the upside. Um, if I'm playing to the downside, if I'm being safe, it would be this wick here. Um, but let's say, for instance, let me turn off the magnet here. Price comes back down to here and touches. Then my entry can be at that last touch here. So hopefully this is making sense. So say we reject here off of this pattern, come back up, and then we finally reverse and break through this pattern here. Let me stretch this line out so it's a little bit clearer. This yellow line, sorry, you can enter the trade here, but there's a good chance that you might get faked out. It might reject and go back up and stay within this range. So this is going to be the riskiest entry, is taking it right at the break of the pattern. The safer entry is going to be taking that last place it touched and rejected or bounced. So your safer entry is going to be here. If you're looking to be super safe, your entry can be down here, but I wouldn't recommend that. You're really going to miss a lot of the move. And if this move happened, you're really looking for it to come down and test your POC or virgin POC. When you get to this range here, you're probably going to see actually, I think there's a pen tool on here. I've never used it. Let me see. Brush. But so once you get here, you'll probably start to see some consolidation. Once that consolidation happens, again, you're just going to start drawing out your technical analysis. So let's say we have rectangle consolidation here. For rectangle consolidation, I actually generally, oh gosh, I'm trying to chart with my pointer. For rectangle consolidation, I actually normally will draw a box rectangle. Sorry, not a box on a rectangle. But I'll draw a rectangle around that consolidation area. And then I'm waiting for the stock to pick a direction. Once it picks a direction, and breaks out of this box, you can take puts here, or if it were to break to the upside, obviously you can take calls here. One thing I will say is we generally will see a retest, and the move from the retest is generally going to be bigger. It doesn't matter which direction, if we're taking calls or puts, but you can absolutely play the break of the consolidation here to the downside. Just know there's a good chance there will be a retest, and the retest move will be bigger than the initial move. Anyway, I hope that's clear. We'll look for some of these plays on actual charts. Let me just get rid of all this stuff. While I'm deleting this, I'll just say really quickly, so the POCs are points of control. Points of control are where you have the largest price action on any given day. So buying and selling. So this red line would be the area on the chart where you have the most buying and selling taking place on any given day. So for this, it's January 14th. So this line here is the January 14th virgin point of control. And it remains a virgin point of control until it gets touched on the next day. I'll try to show examples of that. Volume profile. I'll just show you guys very quickly. Your volume profile, once you load the session volume profile onto your chart, you're going to want to change your row size to 200, and the value area volume you'll want to change to 68. Some people use 70, and there's nothing wrong with that. It's really like a personal preference. I've always used 68% volume area. There are a lot of traders that use 70%. I'm trying to see. Oh, and one other thing about the POCs is you want to draw them on the 30-minute time frame. If you're using ThinkOrSwim, you want to draw them on the 30-day, 30-minute time frame. So we'll just take a look at Apple, trading Apple on this day, on the 3-minute. And this is really what I want to cover today, is how I trade. Obviously, having full access to the candles makes it a lot easier to say, oh, like I would or wouldn't take a trade here. But I'm going to try to be as, what's the word? Um, I can't think, but I'm going to try to be as non-biased as possible. That's what I was looking for. Um, and actually, this is going to be kind of a hard chart to even show you guys much of anything. I see a few places where I would play um, based on what's happening, but all in all, like this is a typical day, meaning um, we opened and we saw a pretty good breakout movement. But then what makes it typical is it reversed and came back down and then back up, back down, back up. So you do want to recognize what kind of days you're having. I'm not going to cover the different type of days right now. It'll be too much for one video. We can get into that another day. But typical days, um, you want to recognize that you're having a typical day, because once you recognize a typical day, you know how to trade it. So for me here, well, this first move here, I wouldn't be trying to trade because I don't trade the first 5 minutes of the open. And there's nothing here for me that's saying get into a trade. Like here, you almost have like if I saw this during trading hours, I might. I'm sorry, like after the first 5 minutes, I would probably try to jump in here. Um, except this wick negates what I'm saying, but I'm just showing this as a reference. Um, but so here we have, and again, this wick makes this not true, but I'm just showing this as an example. This here would be a bull flag, right? If this wick didn't happen, and the reason I'm saying if this wick didn't happen is once you have, once the flag is below 50% of the pole, it's no longer a flag, a bull flag or a bear flag. So, um, and again, there's just nothing in this first move that I would try to trade. And this is really important. This is where I think a lot of traders make mistakes is they start trying to force trades like, oh, this massive move is happening, I don't want to miss it. And so they'll FOMO in, and even if you FOMO'd in here, like you still end up being good, but there's a good chance it could reverse here. And you just really don't know. If you're FOMOing or, chasing a trade, it's just things that I avoid. So one trade I am seeing that I would take is right here. And this is going to be the biggest thing for trading. You want to just step back, take your time, and look for good setups. And this might seem crazy for people that are new, but drawing your technical analysis on charts as it's happening will really help you with taking trades. So for here, we have a bear flag. We can easily play the break of the bear flag here or the retest of the bear flag. So if we zoom in, you see there's a wick that actually comes back and retests. And this would be a great entry. This move here might not look like much, but if you're trading correctly with a 2-to-1 risk reward, that move right there is easily like a 20% move. And if you're consistently taking 20% profits, or trying to grow your account by like 5 to 10% a day, um, all of that compound interest will grow very quickly, and you'll be very successful in trading. And then so here's another play that you could take. Right here we have a double bottom. And if recognizing that you have a double bottom is not enough, this hammer candle is a reversal sign. And again, you want to slowly start to recognize these things. Here, that's a pretty ugly candle, and you see we have a red candle afterwards. Um, but you can easily take an entry here on a double bottom to the upside, and you would get paid. Um, but the big thing is you want to do a 2-to-1 risk reward, and you don't want to get out of trades early. So like a lot of people will take a trade, they notice that it starts going red for whatever reason. They'll hop out too quickly, and right after they hop out, it reverses, and what they thought was originally happening happens and plays out. So you want to have a set stop loss, not a physical stop loss. So you don't want to type in an actual stop loss number on your trading platform, because the money makers have access to that information. I'll get into that more in just a second, but if like if you take a trade, let's say you take $100 trade, a contract for $100, so your stop loss is going to be 80 because you're using a 20 to 40 risk reward, 20% negative, 40% positive. So you hop in that trade and you set your stop loss at $80, and we as traders, retail investors, have access to level 2 data, which means we can see like the buying and selling. If you look at like Active Trader on whatever platform you use, you'll see you can actually see how many buyers there are at any given price and how many sellers there are at any given price. Well, the market makers, money makers, have access to level 4 data, and they can see stop losses and they can see limit orders. And so if you buy a contract at $100 and immediately place a stop loss at $80, the market makers can go, oh, I can dip this stock, with just a little bit of money, pick up this, bunch of contracts cheap at $80, and then send it and sell it back to those retail investors at a higher premium. And $20 might not sound like much, but when you're doing $20 times millions, it adds up very quickly. So you never want to use a physical stop loss. Like I said, market makers can see those values. You want to use just a mental stop loss, and you want to respect it. If you keep respecting negative 20% and keep taking positive 40%, you only have to be correct on your trades 34% of the time to be profitable. If you start selling too early, this is a lot of traders do this. They'll take a trade, it'll be a little bit green, they'll sell really early because they see something that they think looks scary on the chart, and then they generally end up being correct. It'll pull back a little bit, and then it bounces and shoots up to like their original sell target of their 40%. And now you just FOMO'd out of that trade early, and then we do the opposite when it comes to cutting our losses. It goes negative 20%, and we go, oh, if I hold it just a little bit longer, it might go green. And then the next thing you know, you're negative 40%. And you're like, oh, shoot, like now I really hope it bounces because I'm 40% in the hole. And so you're still holding it, praying for a bounce, and then it goes negative 60%. And at that point, you're like, shoot, like, I mean, I've basically lost, you know, over half of the contract so far. At this point, I might as well just keep holding it and seeing if I'll, you know, get a reversal. And then the next thing you know, you're negative 80% and negative 90%, and then you're down to zero. That's how you go broke, is cutting your wins too early and holding on to losers too long. So if you make set rules for yourself, like negative 10% for your stop losses and positive 20% for your wins, or negative 20% for your stop losses and positive 40% for your wins, again, you only have to be correct 34% of the time. So if you keep doing that consistently, you know, and basically it's like flipping a coin. If you just keep flipping that coin, odds are you'll be 50% correct at least, and you'll be green. So that's what you really want to do as a trader. It's hard mentally to do it, but you want to tell yourself whatever your goal is, negative 10% for stop loss, positive 20% for winners, or negative 20%, positive 40%, negative 40%, positive 80%, whatever that looks like for you. It doesn't matter. I wouldn't push it too far out. Negative 10, 15, or 20 should be good for stop losses, and positive 20, 30, or 40% should be good for taking profits. Sorry, I'm just looking at the chart here really quick. So when you start to see consolidation, you want to draw this in. Like, sorry, I got to turn off my magnet here. This here for me is like, I'm not trying to trade in here. I don't know why my trading view is lagging. Once you recognize consolidation, draw a rectangle around it. One, just to what you said, you really want to do at least a 2-to-1 risk reward. So negative 15, positive 30. But I mean, you can do negative 15, positive 20. Oh, you're saying negative 15 to 20% gain. I mean, you could do that. I would really shoot for a 2-to-1 risk reward. It makes your odds to like winning to losing better. So anyway, basically anytime you see consolidation, just draw a box around it or a rectangle, whatever. And then you can play the breakout of those rectangles. So once we grab some rectangles here, and you know, as the day progresses, your rectangles might get bigger. So if I drew this rectangle here, you know, based on these first 3 candles, and then I notice like this candle barely came out of the rectangle, I can extend it down to include that one. I'm not going to try to grab this wick. So like I was saying earlier, your retest is always going to be better. So when this came down, you don't have to grab this initial move. But when it retests here, this would be the move I'm trying to take. And I'm going to try to sell it when it enters this consolidation area here. So really for me here on Apple, there's not a whole lot of trades, and that's okay. We can go to another chart. Why is this not working? Oh, I'm using this pen. Derp. Magnet's good and bad at the same time. So for me, on Apple on this given day, I would play the breakout of this bear flag. I would play the breakout of this bear flag, and I would try to play the retest here. See this? This second candle, we retested the consolidation area. This is where I would try to enter the trade, play to the upside here. And that would be really it for the day for me on trading on Apple. None of this interests me. You know, the last hour, power hour can be good. And yeah, I mean, you could take this trade. Again, you don't have a retest. And that's what I would be looking for. I'd be looking to enter a retest here. But generally for me, after the first few hours of the trading day, I'm done. I'm not taking trades out here. Power hour can be fun and exciting, but for me, this is too much consolidation to really play anything. Oh, and sorry, 3 trades. The break of this bear flag, the break of this bear flag, this double bottom here, I would take, and the break of this, the retest of the break of this consolidation area. So like 4 trades I would look to take here on Apple. And again, this is trying to be as non-biased as possible. What I really recommend to people, especially if you're newer, you really want to step back and take your time and not rush into trades. Even if you miss something, you'll be better for it. Like if you're watching Apple here and you draw this bear flag and you miss the retest here on this wick to buy puts, at least after it plays out, you knew that your technical analysis was right. Or if you happen to notice late that there's a double bottom here and it reverses and it goes green, at least you recognized that it was happening. That's what's important. And so you really want to just step back and start drawing on your charts, recognizing all of these different patterns. And when you see them play out, it's just going to give you that that confidence going forward. Hey, like I recognized a bear flag before, or I recognized a bull flag before, and it made a pretty good move, or I recognized a double bottom before, and there was a good bounce from there. So the next time I see, you know, like a double bottom, and especially this one with a hammer, double bottom with a hammer, like this is easy entry for calls. So you really just want to start recognizing those things. And this is another thing I also think is important. Technical analysis can be very intimidating when you're first starting. Like, oh, am I drawing the line in the right place? You know, is my bear flag or bull flag in the right place? Is that really a double bottom? One thing I will say about technical analysis is it is not a science. It's an art. So it's not something that is like that's set in stone. It's very objective, or sorry, it's very subjective. So if you give 10 traders one chart, most of their lines are not going to be exactly in the same place. They'll probably be close, but they probably will not be exactly the same. So don't overthink it. Don't overcomplicate it. Look for your patterns, draw them in. And if you're not feeling confident, just start drawing your patterns in and don't take trades. And then another thing that I'm always telling people that are newer is focus on 1 chart pattern a day or 2 chart patterns a day. I would start with flags, bull flags and bear flags, because they happen more often. You'll find a lot of bull flags and bear flags. And you'll notice, like, I don't draw like the line here of the flag because I don't care. I'm not looking to play to the upside. if I have a bear flag, I'm looking for a break to the downside. So I don't bother drawing the other part of the flag. There's no reason to. Um, and there's one here as well. So there should be a line here. I don't care about that because I'm not looking to play it up. Um, so I literally just draw a line. I don't draw the pole. I just drew the pole here as a reference for newer traders so you can actually see the flag. I'll just draw a dashed line and take the break of it. Or if I'm being safe, and again, this just depends on your risk level. You can take the trade here. If it happened to retest, of course, you can take the trade when it retests the flag. Your safer entry is going to be this last touch here. So right there. And you can see, if you're looking at this, where that the safer entry is, you got a green candle on that one. And that's because this was a buying area on a 3-minute. So people started buying again at that same area. So that's why it's the safer entry. But so really, when you're starting out, pick a few patterns. I would highly recommend always looking for consolidation and always looking for flags when you're first starting. Excuse me. You never want to take a trade in consolidation. And so once you recognize where there's consolidation happening, that's a no trade zone. And then the break of your patterns you take. And so when you first start out, draw your bear flags, bull flags. And again, if you're not comfortable, just watch how they play out. Once you get comfortable, start taking those trades. Safer entry versus riskier entry. That's up to you as a trader, depending on your risk adversity. Always draw your consolidation areas. And once you're feeling really comfortable with bull flags and bear flags, then start looking for other charting patterns. So you can go on Google and search for charting pattern cheat sheet, download that, and just every day try to add a new pattern to your trading arsenal or toolbox, and start trying to trade those as well. Once you have all the charting patterns down, then you want to go on to looking for get like a candlestick pattern cheat sheet, and then spend one day looking for hammers. Spend another day looking for abandoned babies. And basically every day you just want to keep adding to your trading toolbox, whether it be charting patterns or candlestick patterns, until you understand all of them. And then you're just going to be that much better as a trader. And I'm going to add also, when I first started trading, I thought all this technical analysis was BS. I'm like, oh, that doesn't work. There's no point in learning, or drawing a triangle on a chart. Because, it's just stupid. It doesn't work. And boy, oh boy, was I wrong. Or I don't even know that I thought it was stupid, but I also thought it was just too complicated. And if I had just started right away, like recognizing patterns and drawing them in, I would have been profitable or successful way faster than the length of time it took me. I guess what I'm trying to say is I wrote it off as like too complicated, and I guess I was kind of scared of it, but also thought that it was kind of BS and that it wouldn't really work. And it works extremely well. So make it not scary for yourself, and dumb it down. Start, like I said, with one pattern, learn it really well, then learn another pattern, and just keep slowly adding to your trading toolbox so that you're every day you're growing a little bit as a trader, and soon all of this stuff will be so easy that you won't even really need to draw lines. Like it'll just pop out at you and you'll see where to take trades, because you can just see them just by looking at the chart. Like I can look at this chart and I can see right here, this red candle's an inside bar. If you're trading inside bars, you're going to take the break of, um, let me turn on my magnet really quick. You're going to take the break of the high or the break of the low. And so in this case, you could say if you were trading inside bars, um, you would take this trade here. You would end up taking calls. And yeah, you could have made whatever 5-10% on this move. Um, I'm not saying trade inside bars. I'm just saying you want to recognize these things as a trader. When you look at a chart, inside bars should pop out at you, outside bars should pop out at you, flags, cup and handles, head and shoulders, pennants, bearish, bullish pennants, triangles, all that stuff should pop out at you pretty quickly. But like I said, when you're first starting, dumb it down, make it easy, and always ask yourself, like, am I in an uptrend? Am I in a downtrend? Here on Apple, we go from an uptrend to a downtrend, back to an uptrend, back to a downtrend, uptrend. We actually started a downtrend here, I think. It's kind of hard to say. This is our, yeah, it's almost identical. So this is our um, higher low right here, and it's actually a double bottom. It actually lines up perfectly here and here. It's a double bottom. And actually, yeah, that would have been a good trade as well. So anyway, you just want to dumb it down, slow it down, um, so that all of these things start to pop out at you. One, how many trades do I take on average on a day? I don't think how many trades is important. I kind of have a goal for myself for like 5 to 10% growth on my portfolio a day. And if I take one trade and I'm up 5%, I'm done trading for the day. I'm not trying to give my gains back. A lot of people's psychology will change. Like if you have a few losing trades in a day, people will start revenge trading. It's important not to do that and be like, oh, I've got to make back what I lost. Sometimes it's better to just call it a day and walk away, and come back the next day stronger. But so, I mean, if I'm answering your question, I probably average anywhere from like 2 to 5 trades a day. But it's not, again, for me, it's not about how many trades I'm doing. It's more about how big those trades ended up being. And I guess this is very important as well. I'm talking about a 2-to-1 risk reward. Let's just say you played this bear flag here, but let's say this bear flag ended up being like a massive move, and we go from here down to this POC. If you're buying one contract, you are not playing from here to here, because from here to here is not going to be a straight line. You're going to have, some reversals happening, ups and downs. It'll finally end up getting down here. I love you more, Cyber. DM me later, okay? I'm joking about that, but yeah, we'll talk later. But so if you take this play here and you buy puts, if you buy one contract, like once you're up your 20 or 40%, get out. Don't even think about it. I wouldn't be mad at you if you're doing like a 2-to-1 risk reward and you're trying to go for 40%, but you're at 30% and you see this candle, I would hop out at 30%. There's nothing wrong with cutting a little bit short when you see a scary ass candle like this. Okay. Um, there you can say, yep, I'm good with my 30%. I don't think I'm going to get to 40%. And I'm going to take my profits here. And there's nothing wrong with that. But just don't do that too often. Don't cut your trades early too often. Unless you're cutting your losses early often as well. But so we have one contract here. We're going to get out at our 20-40%, take our profits, and we're not going to look back. If you do look back later, you're going to go, shoot, that ran 300%. And, if I just held it, my account would be up XYZ amount, blah, 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 blah. Yeah, but if you tried to hold it, there's a good chance you end up losing the whole trade. Yes, what Cyber just said, compounding gains are massive. Cyber can post a chart, but basically, like, if you have a $1,000 account and you grow it 5% every day for 170 trading days, you would have 350-ish $1,000 by 170 trading days. But so same concept. If you took 20 contracts of Apple here puts, you can take this initial move down, and take your 20-40% profits. And then let's say at that point, we see a pullback. Here you can sell 18 contracts if you have 20 of them, or you could sell 15 of them if you have 20 of them. And even if you see this pullback, you have to figure out where your stop loss is from here. But let's say we see a little pullback, which will always happen, before we see more downside. But so from here to here, you sell 15 or 18 contracts. This trade was already profitable for you. Now at this point, you can afford to leave a few runners to see if there is more downside. And if there isn't more downside, you just figure out exactly where your stop loss is and you get out of the trade when you hit it. So obviously, by holding 2 or 5 contracts from here up, you're losing some of your profits, but that's where you're able to get your 200, 100, 200, 300% movers, is with those contracts that are free runners after you've trimmed and took your initial profits. But if you have a smaller portfolio, you really just want to focus on grabbing those 20-40% gains consistently over and over and over again, until you have a big enough account to buy multiple contracts and leave runners. RC, so between 10:30 and 11, would that form a bull flag around 11? Let's see. Almost, but not quite. This is really going to be rectangle consolidation here. I can see what you're looking at exactly, and I'll tell you why this is not a bull flag. I got to turn off this magnet again. So you're looking here, correct? And I'll draw the whole thing out, so I can really explain why this is not a bull flag. So here's our pull. Honey, I'll get to you in just a second, okay? So, actually, this is kind of iffy. I would have to measure this, and I wouldn't measure this while I'm trading. It's just not me. You as a trader, if you want to measure this, you can, but your flag cannot be more than 50% of the length of your pull, and I'm pretty sure this is more than 50%. It's close enough to being more than 50% for me as far as calling this a bull flag. The other thing with bull flags is they're going to be measured moves. I might do this backwards. I apologize. I am. ThinkOrSwim, you draw your fibs one level, and on TradingView, you draw your fibs another direction. So, God, why is it so laggy? I don't understand. For your, and actually, you know what? I'm going to take it back. It has to be a bull flag. A bull flag is going to be a measured move. And so if you draw your fib if you're using TradingView from the low to the high of the flagpole, you'll get your sell levels. Your first trim would be this 272 level, which you can see we hit. And your second trim is going to be the 618 level, which we do not hit. Actually, yeah, we do right here. Barely tapped it. But so, with options, obviously, you're not going to want to hold through all of this chop. Your theta is going to eat you up, especially on a Friday at the end of the day. Unless you happen to be in the money contracts, theta is just going to wreck you here. But so, yeah, this actually is a bull flag. And again, it's going to be a measured move. On TradingView, you draw a fib retracement from the bottom to the top of the flagpole. Your first trim is going to be the 272 level, and your second trim will be the 618 level. And you can see both of those levels were reached. But with options, like I said, we're not going to hold through all of this chop to try to get up to the 618. And this happened after hours as well. You would just get wrecked on theta decay here. But so yes, that is a bull flag. Good catch. Okay, so Henny, you're on TradingView to use this indicator, the VPSV, which is actually, if you search session volume, which is the one that gives us the volume profile and our POCs and our value area, you have to have a subscription. So you have to pay. You have to pay for a subscription to TradingView in order to use this indicator. So that's what that is. One thing I will say about TradingView, I don't like how it highlights the value area. So you might want to draw lines on here to highlight this magnet, the value area for yourself. And I'll explain why in a second. I want to answer Henny's other question. Do I have a general rule on how many contracts to buy at one time? Yes. So you want to use a basically 1 to 2% of your total portfolio as your risk. So that can look several ways. Like if you have $1,000, the most you want to risk is 20%, which would be $20. So you can either buy a $20 contract and let it go to zero, or you could buy 100 contract and let it go to negative 20%. Either one would be your 2% risk that you should be risking on your on like $1,000 portfolio size. So hopefully that makes sense. So it's just math. 1 to 2% of your total portfolio is the most that you want to risk, And that can be one of two ways. You can either risk $20, 100% of it, or you could risk 20% of $100 with $1,000 portfolio. So the reason that I highlighted this value area here, and let me show you guys. So the value area, 68%. And like I said, this is not going to be a video on value area per se. I have videos on my channel that cover value area, volume profile, and POCs way more in depth. I just wanted to cover one thing about the value area, which is I have my value area here, which you can see is highlighted. This darker gray area is still part of the volume profile. It's just not where 68% of the total trading volume took place on this day. And so there's a rule here, and it's a pretty good rule. If we leave the value area and then come back into it like we do here, there's an 80% chance. So this is called the 80% rule. 80% chance that you'll go from the top of the value area to the bottom of the value area. And then the same would be true for coming from within the bottom. There's an 80% chance, and you can see it here. When we enter the value area here, we end up going all the way to the top. So 80% of the time, when you exit the value area and come back in, 80% chance you'll go from the top to the bottom, or if you exit and come back in from the bottom to the top, 80% of the time. So that's a pretty safe trade to take as a trader. On top of all of your other technical analysis, you can take those breaks of the value area for puts or calls, and there's an 80% chance that you'll be correct. So. Anyway, so on this video, we've been going at it for about an hour, and I think I've covered everything I really want to cover. Your main takeaway as a newer trader should be to find one or two charting patterns and focus an entire trading day on just finding those one or two charting patterns. And like I said, I would really recommend focusing on rectangle consolidation and bull flags and bear flags. And then once you feel confident trading those bull flags and bear flags and the rectangle consolidation, then you want to start focusing on another charting pattern, spend a day learning that, and then get to the point where you're focusing on learning candlestick patterns. Burton, I'll get to you in a second before I finish up. There's one thing I did forget to mention, actually, really quick. These rectangle consolidations are going to be measured moves as well. So in this case, you can see this rectangle is 0.18%. So when we break the rectangle like we do here, we should see a positive 18% move minimum, which we do. Right? You guys can see that 18% would be right here. And if I move this, you can see we actually went above that. So you can actually physically measure the size of the rectangle and measure how big of a move you should see as a minimum when you break out of a rectangle consolidation. And if you want to see something that I think is pretty exciting, look at Amazon on the month chart, and you should see about a 16-month period of rectangle consolidation that is massive. And when that finally gets broken, it's going to be a massive move. So in this example, if it breaks up, you'll take puts. So you're talking about here. Oh, no, I'm sorry. In this example, if it breaks, I think you're talking about here. 80% chance it goes from here to here. You would take calls. If you're talking about here, I would take puts when it enters back within the value area. This would be where you take puts down. I'll give you a second to answer because I know there's a delay on YouTube. But you would take puts if you cross above the value area and then back down into it. You would take puts here down to the bottom. For calls, when you leave the value area and come back up, you would take calls here to the top. Or not even to the top, or not even to the bottom. Get your 20, 40% and get out of the trade. All right, so it looks like I've answered all the questions. If I didn't answer a question that you had, just hit me up wherever. It doesn't matter. Discord's best, but you can type a message here on YouTube. I'll see it. Worst case, you can reach out to me on Twitter. The only thing with Twitter is they never tell you when you have like a pending message. If it's not somebody that you're friends with, or if you don't already have messages with them, it just like goes into a hidden folder. On Tuesday, if it breaks up out of the area, you would take puts. I'm really sorry, Burton. I don't know exactly what you're talking about. If you happen to follow me, or like if you happen to be on Discord somewhere, just send me a message with the chart. This is the Apple 3-minute chart. Or like I said, on Twitter, just message me and show me what you're talking about on the chart. Just draw an arrow or something, and I'll go over it with you. Discord will be better because we can do like a video call and I can explain things to you. That's awesome, RC. So like I said, I mean, guys, just this isn't a race. So take your time, really step back and slow down. People always want to just rush into trades and you're just going to lose money. Find your technical analysis, draw your patterns, take it slow, learn a pattern or two a day, and just keep adding to your trading toolbox. And before you know it, all of this stuff will be easy. And a big thing I didn't talk about today is volume. You really need volume for trades. Without volume, your trades are not going to succeed. But I didn't cover it in this video because I talk about volume in basically every single video I do. So I have videos that talk about, like I said, I have videos that go over volume profile, value area, POCs, and volume very in depth. And I didn't want to make this a 3-hour long video trying to cover those topics as well as chart patterns and how to take trades. Hey, what's up, Pink Roses? It's good to see you here. Very cool to see you here. That put a smile on my face. So yeah, Burton, I really hope you reach out to me somewhere. Because I want to answer your question. I don't really know exactly what you're asking me. So if we can do a one-on-one call or something, because based on what you're saying, I don't think you're understanding me. So I do want to make sure that you do understand. Hey, what's up, Stuckaro? BTC in the house. Love it. Yeah. So anyway, most of you have, a shared Discord server with me. So if you have questions, you can always hit me up on Discord, DM me, whatever. I'm always, trying to help out as much as I can with people's questions or what have you. So, and if you don't have a shared Discord server with me, you can always just hit me up on Twitch. All right. I mean, on Twitter. I'm sorry, I'm not on Twitch. All right, everybody. Have a good rest of your weekend, I guess, and good luck, everybody, on Tuesday trading. If you're newer, take a step back, draw your patterns, take time, learn them. Don't overcomplicate it. Don't be scared by it. Just learn a pattern a day and get better and better. And before you know it, all of this will be so simple. Anyway, much love, everybody. Like I said, if you have questions, feel free to DM me or reach out. And good luck on Tuesday with your trading.